All right, let's get right into it. We've got a real mystery on our hands today, something that gets to the very heart of our financial system. We're calling this one the case of the missing watchdogs.
Seriously, just think about this for a second. When you deposit your hard-earned money into a bank account, who's actually making sure that bank isn't, doing something reckless with it? You kind of assume someone is watching, right? But who?
Well, believe it or not, a huge part of the answer is supposed to be, well, you. Yeah, you. There's this big theory called market discipline, and the whole idea is that regular folks, depositors, just like us, are the watchdogs. If a bank starts getting a little too wild, we're the ones who are supposed to sniff out the danger and punish them for it.
So, here's how it's supposed to work. In theory, it's like a chain reaction, right? Step 1. Banks have to share their financial info. Step 2. We, the watchdogs, are supposed to look at that info and figure out who's being safe and who's being reckless. Step 3. We punish the risky ones, either by demanding they pay us higher interest or we just take our money and walk. And all that pressure is meant to force the banks to be more careful. And look, this isn't just some dusty old economic theory. This is a big deal. It's actually the third pillar of the Basel III Accords, which are basically the international rulebook for keeping the whole global banking system from falling apart.
Okay, so the theory sounds pretty solid on paper. But does it actually work? Like in the real world with real people and real money? Well, that's where our story really kicks off. We're going to dive into this fantastic academic study that put this whole watchdog idea under the microscope in Central America.
So, let's look at the case file. The lead investigator, a researcher named Edgar Tovar Garcia, examined 30 commercial banks across 6 different countries in Central America. But the really important detail here, the time frame. He looked at everything that happened between 2008 and 2012.
And man, what a time to be looking at banks. This wasn't just any random 4-year period. The study starts in 2008, right as the global financial crisis is exploding and shaking everyone's faith in the entire system. I mean, confidence in banks was in the basement. If there was ever a time when you'd expect everyday people to be paying super close attention, to be watching their banks like hawks, this was it.
Okay, so how do you actually find these watchdogs? It's not like you can just go out and ask people, hey, are you disciplining your bank today? No, you have to be clever. You have to hunt for the clues hidden in the financial data. So the researchers were looking for 2 main clues. First up, what they call the price signal. Basically, were the riskier banks forced to pay more for your money? Did they have to offer higher interest rates just to get you to stay? The second clue was the quantity signal. This is even more direct. Were people literally voting with their wallets? Were they pulling their cash out of risky banks and moving it somewhere safer?
But that brings up a good question. How do you even tell if a bank is risky in the first place? Well, you look at its report card. The researchers dug into all the key numbers. Things like capitalization. That's the bank's own rainy day fund, its financial cushion. Then there's asset quality, which is a fancy way of asking how many bad loans does this bank have? And of course, profitability and liquidity. Is it making money, and does it have enough cash on hand for withdrawals? It's pretty simple. A good report card means a safe bank. A bad one? That's a huge red flag. All right, so the stage is set. The researchers had all the data, they'd been following the clues, they'd graded all the report cards, and they were ready to announce their findings. And what they discovered was a complete shocker. Just not what anyone was expecting.
So let's start with that first clue, the price signal. Were the risky banks paying higher interest rates to keep their customers? The answer was a resounding no. The study found almost no evidence of this happening. The watchdogs, it seems, were not barking for better deals.
Okay, fine. But what about the other clue? The quantity signal. I mean, surely people were moving their money to safer banks, right? That's just common sense. But check this out. The expectation was crystal clear. You reward the safe banks with your money, and you punish the risky ones by leaving. The reality? It was the exact opposite. The safest banks, the ones with the best financial cushion, they actually got fewer deposits. And get this, the banks with more bad loans on their books, they got more deposits. It's completely upside down.
Let that sink in for a second. The safest banks were losing deposits.
And at the same time, the riskiest ones were gaining them. It's like the watchdogs weren't just missing, they were actively rewarding bad behavior. Now, this isn't just some weird, quirky finding for a boring academic paper. No way. This verdict has absolutely massive implications for how we think about the safety and stability of the entire financial system.
So the study's final conclusion was pretty blunt. It found zero evidence of market discipline. None. During the biggest financial firestorm in decades, the one key mechanism that's supposed to act as a safety brake just failed. The watchdogs were completely missing in action.
So, why? What happened? The author himself actually offers a pretty big clue. He points his finger at weaknesses in the disclosure of information. And that's huge. Think about it. Maybe the watchdogs weren't asleep on the job. Maybe they were just blindfolded. I mean, if the banks aren't giving people clear, easy-to-understand information, how on earth can we expect anyone to make a good decision?
And that's where we're left, with a really, really unsettling question. If this core idea, this pillar of global finance that you and I will keep the banks honest, if that completely falls apart when things get tough, then who's left? Who is really watching the banks? Because if it's not us, then who is it?